A freezing winter forecast drops, and, well, natural gas just goes crazy. A headline hits the wire, and crude oil instantly spikes. Welcome to the deep dive. Today we're looking at how everyday traders use commodity CFDs to ride these massive global events.
Right, and to do it without having to actually store 1,000 barrels of crude in their backyard, which is, the whole appeal.
Exactly. Because these markets react to visible, real-world catalysts in real time, the appeal is super obvious. But surviving them takes a totally different mindset than just buying and holding regular stocks.
It really is. I mean, because we aren't institutions, we have to rely on CFDs for this kind of exposure.
Okay, let's unpack this. The real draw here isn't just skipping the physical delivery of coffee or gold, right? It's the leverage. It's like placing a wager on a house's value going up or down without actually having to get a mortgage.
Yeah, and what's fascinating here is how that leverage acts as a magnifying glass on your flaws as a trader. It's just so easy to get seduced by the low barrier to entry.
Oh, for sure. It's like strapping a rocket engine to a bicycle. You get to your destination incredibly fast, but hitting a tiny pebble will completely destroy the vehicle.
Right, and that pebble usually comes in the form of a sudden market reversal.
Mm.
Leverage doesn't just amplify potential profit, it accelerates how fast your margin gets chewed up.
By even a fraction of a percent, right. So if leverage makes it that easy to get wiped out by a single weather report, how do you even build a strategy that survives the week?
Well, the source is pretty clear on this. You don't rush in. You have to narrow your focus to just one or two commodities, usually gold or crude oil.
See, here's where it gets really interesting because my instinct, and probably the instinct for anyone looking at global markets, is to spread the risk. Like, why not trade 6 different commodities right away so you're not overly exposed?
Because in this space, spreading your attention is how you guarantee failure. Every market dances to a completely different beat.
Wait, really? So diversification is actually bad here?
For a beginner, yeah. Gold is essentially a psychological mirror of the US dollar and interest rate yields. But oil is intensely physical. It's about actual barrels on actual ships, OPEC decisions, and geopolitics.
Okay, I get it. So learning the underlying mechanics of one market deeply beats watching 6 of them superficially.
Without a doubt. You also have to factor in the invisible mechanics of the trade itself. Things like the spread or overnight holding costs.
Oh, right. Because if you aren't paying attention, those overnight fees will just silently bleed your available margin dry while you sleep, even if the price hasn't moved at all.
Exactly. And even if you master the rhythm of gold and you factor in the holding costs, an unscheduled event like sudden conflict in the Middle East can instantly reprice the market.
Which brings us to the actual execution. The guide highlights using specific fast platforms like MT4, MT5, cTrader, or Monaxa. Why is the software itself so critical?
It basically comes down to latency. When an unscheduled catalyst hits, you get violent repricing. If your platform lags by even half a second while you're executing a stop loss, you take massive slippage.
Wow, half a second. So you really need an ecosystem that lets you define your entry, stop loss, and take profit instantly across multiple markets.
Instantly and without friction, yeah. Speed is everything. And your first month should focus purely on consistency and journaling trades.
So what does this all mean for your daily routine? Like, how much time does this actually take for the person doing it?
This raises an important question about what kind of trader you are. Your schedule really dictates your style.
Meaning, if you're stuck in meetings and can only check charts occasionally, you can't be day trading.
Exactly. Trying to day trade the minute-by-minute volatility of oil will ruin you if you aren't watching. You have to be a swing trader instead.
So basically, the first month shouldn't even be about making money. Keep your risks small enough so your skill has time to compound.
Right. Survival is the only metric that matters at first. You trade microscopic sizes just to map out your own blind spots.
It's not about catching every massive headline-driven move. It's about choosing one arena, understanding the microscopic contract details, and staying in the game long enough to learn its rhythm.
Absolutely. Master one thing before moving to the next.
Which leads us to something pretty fascinating to chew on. If commodity prices are deeply tied to visible, real-world headlines like a freezing winter or a supply chain strike, how might your everyday news consumption already be acting as an unofficial mental trading journal? Just something to think about the next time you check the weather.